You've got to show up. You've got to make those relationships in order to find a partner that sort of matches your strengths and weaknesses, and be able to put your entire drive into getting that first syndication.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 394. Rebecca Moore is a multifamily investor and syndicator. Through her company, Starboard Equity, she and her husband control over 900 units. Her strengths are strategic partnerships, investor relations, capital raising, and asset management. Rebecca also moved from sunny San Diego to live and invest in Dallas, Texas. And she did that in order to have access to more and better investment opportunities. Rebecca, welcome to the show.
Thanks for having me, Brian.
Why don't you tell us a little bit about yourself and how you got started investing in real estate?
My husband is, or I should say, retired naval officer. And while we were traveling back and forth across the nation for his different assignments, we would buy rental homes and keep them rented with the use of a property manager. So when it came time for him to retire from the Navy, we were thinking, what should we do with these houses? How can we put them potentially all under one roof? And in our minds, it was, of course, maybe a fourplex, sixplex, eightplex, who knows? Because we weren't necessarily ready to, let's say, buy our retirement home. And we knew how great it is to have that passive income. So what we did is we sought out to find somebody to teach us how to buy, let's say, again, the fourplex, sixplex, et cetera, because we really had no idea. And so when we went to a real estate expo, we realized that there were a couple folks there talking about multifamily syndication. We had no idea there was such a thing of pooling people's money together to buy a larger building. So we decided on a mentor out in Dallas, even though we were living in San Diego, and learned the syndication process. But what's funny is that my husband at that time, he was in charge of a squadron of ships. And so he couldn't necessarily leave. That's not something a commodore or commander of the ships can do. So he says, Rebecca, you go. So even though I was full-time in psychology at the Naval Hospital there in San Diego, I began going out to learn from this mentor in Dallas from San Diego. And there we began our journey of learning syndication and the Dallas market.
Well, who was your mentor?
Sumrock.
Brad Sumrock. Okay, let's start with the Dallas market. Why the Dallas market? Why did you choose to move from San Diego and start investing in Dallas?
California is not a landlord-friendly state, unfortunately. So you can get into certain messes with squatters, et cetera. It is also very expensive, as everybody knows. So therefore, there would be less of a margin of cash flow for us. So the appreciation would be great. And we would probably end up with, let's say, a fourplex that we could afford, even though we would sell all of our houses elsewhere. It's expensive. And so again, in 2014, when I started, Texas, again, was under massive growth and plenty of new jobs. It's within the path of progress. And it was less expensive than California, where we were living, and is landlord friendly.
Talk about your first large apartment syndication. Like, what was it? How did you take it down? And how did you raise the funds for it?
So by being part of a group, it was very helpful for me to have those, what we would call warm leads. So the people in my group understood multifamily And therefore, they understood the process of investing. So that was very helpful on the fundraising side. But let me back up and say that in our group, we had several events that would occur during the year. And so I would fly out to Dallas often. And during that time, getting to know my group people, that's where I found my partner. And that's where many people should be looking for their potential partners, because you're being educated the same way, learning, the same stuff about apartment building. So my first partner was an engineer, which is fantastic because me being a social scientist, together we worked out pretty well. So he really taught me the details of underwriting and considering the Dallas market, because he lived in Dallas. So those boots on the ground were very helpful. And I was able to learn how to sort of talk to the brokers, what to say to the lenders, understanding lending for the first time for, of course, commercial real estate. So proximity. Every time there was an event, I would go to Dallas. You've got to show up. You've got to make those relationships in order to find a partner that sort of matches your strengths and weaknesses, and be able to put your entire drive into getting that first syndication. And that's what I did. And so my first syndication was, again, in Hurst, Texas, which is right in the middle of Dallas and Fort Worth. It was 94-door property. And so being able to fundraise was essentially through the group, because they know, like, and trusted me and my partner. And therefore, we were able to take it down and fund it.
Two-part question here. One is, how did you know you had found the right partner to begin with in that first deal? And then what were some of the things that you learned in the process of taking down the first project?
So in learning who I was going to work with, I had asked many folks to help or to contact me. But the person I'm speaking of is Dustin Miles. And Dustin Miles is well known here in Texas, but now he's just done incredible work. But he was reliable. And the two of us are both reliable people. So when he said he was going to call, I would be there and pick up. When he asked me, find out the quote for the taxes, find out the quote for the insurance, etc., I would have it there for him. So together we could trust each other. And so again, always showing up. That was something. And of course, he's very ethical, transparent, good person, just like myself. And so therefore, there were no red flags.
Always showing up. What did you have to do that was outside your comfort zone? Because I'd imagine stepping into your first syndication, there's a lot that is new to you. What was outside your comfort zone that you really had to get acclimated to? Just
about everything, because again, I'm a PhD in psychology. And so I did not have a financial background. I don't need to talk to other people in a selling type situation to do my business all these years. So talking to a broker even about multifamily, I didn't know what to say, what I'm looking for. I think what most people feel is, am I going to look stupid? So for example, I'm also a coach for another academy. And so that is one of the things that we talk about quite a bit is, what do you say? How do you know, how are you going to look like you know what you're doing when you've never purchased anything before? So I would have to get myself into state, as let's say Tony Robbins says, to get myself, the gumption to call that broker, to call that lender, and not hope that they didn't know that I didn't know what I was talking about. So that is getting my self-esteem up.
Tell our listeners then, since you are a coach, what do you say or don't say to a broker so that you don't look silly?
Asking them to tell you most of the information is very helpful, because they will tell you all sorts of stuff and you don't have to say a thing. Also, just getting that information and saying, I'll get back to you, you'll be all right. But there are many, many things, depending on the deal, that you can ask about. Of course, some of those things are, let's say in Houston, has it ever been flooded? Is it in a flood zone? That can make a difference, as if you know what you're talking about. Talking about, does it have aluminum wiring versus copper, depending on the age? What are the age of the roofs? All these things are important first touch with the broker questions.
Talk about raising funds, like going out to investors and how you started those initial conversations.
Leaning on your partner, who should have more experience than you, will help you with that credibility. And that was certainly my situation. So being part of a larger group, as well as having my partner who was very experienced, that allowed my investors or potential investors to know that I had been studying, knowing that I was with a quality group, and that I could then speak to them about all I have learned and how I have underwritten conservatively as I was taught. Those were some of the first things in getting myself the credibility that they want to feel comfortable making an investment with me.
Did that also help with the broker as well to know, okay, you're with a group that can actually close?
Absolutely. That is definitely something that the broker needs to know, that you're with a quality group.
What were some of the other things that maybe surprised you or that you learned on the first deal that you did that you hadn't expected?
First of all, due diligence. Going through the C-class property into every person's apartment to look it over and seeing how people live was definitely a surprise. And in fact, later on, maybe five syndications later, I had a friend who came out crying, saying, I don't know if I want to do this, because the C-class properties can be very interesting with what you see. So as far as a surprise, that was a big surprise for me.
Is that your niche? And describe what you mean by C-class property so our audience gets it.
So C-class property is typically a 1970s and below property. It's also where the salt of the earth people live, the ones that make America move. So it is not necessarily the teacher, but the teacher's assistant, not the nurse, but the nurse's assistant. It might be the construction worker or the waitress, those folks that serve us every day. And so they don't have a lot of income, but they do want a nice, respectable place to live.
Is that typically what you look for in your acquisitions, C-class properties?
Yes, that has been something that I have looked for mostly now and in the past, but I am moving more toward the B-class property. So just a bit nicer. That means something more in the 1980s, 1990s and such. But the C-class properties are excellent for value add, which means that you can make it a beautiful place and have a nice margin of cash flow for your investors.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy Equity at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
Talk about your investors and just the communications. Like, how do you handle communications with investors as well as transparency as to how the property is performing?
That is one of my strong suits. That's something that I really enjoy, is getting to know my investors and for them to feel as if the property comes alive for them. So I do monthly newsletters to my investors. And what I like to do is put a lot of pictures. I have my managers take pictures of any construction that we're doing, any upgrades that we're doing, any sort of tenant retention parties that they have, even new residents. My managers sometimes take pictures with them and say, this is the newest person who's come in for this week. So I put all of those in my communications with my investors so that they can know this is real and they are making a difference on these properties. In addition to that, I give them about 150 pages of financials so they can see what is financially happening on the property. And of course, within these newsletters, I go through occupancy, move-ins, move-outs. I go through the income for that month, the expenses, the NOI. I give them as much information as I can, so it's fully transparent.
And what kind of feedback do you get from your investors? Do they appreciate all that information?
I think they do. And the thing is that I don't get a lot of feedback because I think they're in the know, because they know what's going on. I do get feedback in great job. Thank you so much. Hey, what about X? One thing that X might be is the cap rates on a bridge loan that we might have. How are those working out for us? And luckily for me, it's good. So they might have just a few questions, but I try to answer everything for everyone in that letter.
Well, I'm glad you mentioned cap rates on floating interest rate loans, because that is one of the soft spots right now, or trouble spots in our space, investing in multifamily and apartments. Can you explain what that is and some of the difficulty it's causing for some properties and their investors?
So a rate cap insurance is basically a product that you buy to cover between the rate that you went in at and where the interest rates are going. So that way you have that sort of insurance coverage, so you're not out a lot of money. Now, one thing I can say is that because of being part of a group of investors, we had the knowledge together. Otherwise, talking amongst ourselves and the presentations that we would go to was the warning: buy a rate cap for the term of your loan. So that was very helpful for us in the beginning of 2021 to 2022, buying those rate caps to cover, because we knew basically this financial winter was coming. So if you don't have a group, you might not know what's coming.
Just to give an example, if you had locked in or started with maybe a 2.5-3% loan, but with a floating interest rate, the rate cap that you're talking about would basically keep it from rising too fast or rising past a certain level. And you buy that rate cap each year, right? So you prepaid for the length of the loan, is what I'm hearing you say. And by doing that, no one really expected interest rates to more than double in 8 months, but they did. So there's a lot of people who are finding themselves upside down because their rate caps expired. They didn't pay for the next year's rate cap, or just the cost of the rate cap has gone through the roof. So that debt service is really crushing a lot of investors. So I'm glad to hear that you were able to kind of sidestep that.
Yes, and I'm very pleased that we were, but it's all through, again, proximity and being with people who are in your business.
I'd like to talk about some of the other stressors that I've heard in Texas, particularly, because I'm hearing you say you're in Dallas and Houston.
Correct.
So are you finding that insurance costs are rising on your units, and how are you dealing with that?
Yes, and it is not fun. It has been a larger increase than any of us would like due to, again, hurricanes there, of course. And so dealing with it is that, first of all, we underwrite with a rather excessive amount of insurance because we know that it goes up here in Texas, but also adjusting and maybe looking for, right now, I'm in the process of looking for other insurance companies to see if I can decrease that cost.
That is something that I guess is a variable that it's hard to pinpoint what that's going to be year to year. But the other variable that I was surprised to learn about is property tax. I'll kind of give you a little context here in Michigan. Your property tax, your taxable value comes uncapped when the property transfers. But then there's a law in place that sort of keeps it from rising more than 3 to 5% a year. And it's really based on the rate of inflation. So you can kind of project what your property tax is going to be year to year. But I was surprised to learn recently that that's not how it is in Texas. Can you describe how property tax works in Texas?
So when we purchase a new building or a building, the next year's tax will, as you said, be applied to the purchase price. So what we do have the opportunity to do here in Texas is to protest those taxes and basically say, no, the value hasn't gone up just because of the purchase price. You need to come and evaluate everything to protest down those taxes. And so that is another added expense that we do every single year, is protest down those taxes. So in our underwriting, we might typically, let's say, 4 or 5%, underwrite 4 to 5% each year for those increases that can occur here in Texas. And again, protest and hope that it doesn't get anything over that. But you have to be aware and you have to prepare for it.
It's almost like a game that the assessor plays where they're just going to reassess every year and raise your taxes, and then you have to fight it. Interesting methodology you have there. What is your outlook then? Where are you right now? Because obviously, as we're recording this, it's mid-May 2023. There's a lot of stress in the market, banks folding, liquidity issues as far as raising money, on the raising money side and getting a loan side. How is that affecting you as a syndicator?
I am very cautious at this time, knowing that it can be difficult to, let's say, raise the money and wanting to be able to get the best loan product that I can. So I would say that I'm not rushing out there to get a deal this year. However, at the same time, I have one in progress right now, and that is because the folks, we had been watching a building for over 2 years. It fit all of the criteria that we wanted. And we knew that because it fell out of sale last year, we knew we were getting an outstanding price and that we did have good debt from the good relationships that we had with our lender. So I have pursued one deal this year, but only because I know the value of it and I've been watching it. And again, having those relationships, knowing that I can fund it and get a good financing for it.
What kind of financing would you leverage in this environment right now with financing being somewhat hard to come by? What would you leverage?
About 65% would feel okay.
Are you going Fannie Mae, Freddie Mac? Like what kind of lender would you go to?
On this particular deal, we actually did continue with the variable rate bridge, but we bought the 1% cap. So therefore, the movement is very little. In fact, we're already what they call in the money. So we already know what our debt payment will be for the term of the loan.
So are you assuming the loan?
No, this is new finance. Again, because of that rate cap, we already know where we're at as far as the debt goes. So one of the reasons why we did go ahead and choose another bridge loan is due to the exit strategy. We would like to be able to exit when we want to. Whereas if we were to go with a Fannie or Freddie right now, it would be costly to get a step down, and the bridge loans worked better. We would like to be able to exit this on our terms rather than waiting for, let's say, the yield maintenance to be up and have that larger exit.
That's a key distinction. Let me just review that real quick. You said yield maintenance. Basically, if you get a Fannie Mae or Freddie Mac loan, there's a huge prepayment penalty if you want to get out of that before the end of the loan. And it's based on that yield that they would have received had you stuck with the loan. So it can be millions of dollars. But the reason that you like the floating rate, and that many people are in floating rate loans right now, is because there is really no prepayment penalty to get out of that. So you can kind of determine, okay, we're going to sell this in 2 years or 3 years or refinance somewhere else. And, of course, right now, there's a lot of people who think we're at the height of our interest rates. Maybe there's going to be one more quarter point increase, but then we'll start seeing it gradually decline over the next year or so. So that strategy makes sense. Like stay, the floating rate with the cap, so it doesn't go up too high, and then refinance or sell when you want to, as you say, when you choose to.
Yes, that's exactly our strategy. Yes.
Rebecca, what is your favorite hack or app?
I'm glad that we talked about this beforehand so I could think about it. And I did say CoStar. CoStar, although it can be outdated information, it's still relevant and useful. And in addition, as a bonus, I also like Neighborhood Scout. Neighborhood Scout is a website where you can look at the address where the building is that you're looking at, and it will give you some data on the crime rates there and see if it's actually somewhere you want to purchase.
Tell our listeners how they can get a hold of you or find out more about you.
At www.starboardequity.com, and that's starboard, like the starboard side of a ship. And join the club, the Starboard Club, so you can find out what we're doing, as well as receive different articles about multifamily so that you can learn more.
Rebecca, thanks for coming on the show and talking about multifamily syndication and sharing some of your experiences with us, especially some of that Texas, the local on the ground Texas knowledge of like how taxes and insurance are working right now. And I appreciated the conversation about the floating cap rates, because I think that's something people need to understand right now, is what that means and how that's affecting the multifamily world and investors right now. So thank you so much for coming on the show. It's been a real pleasure.
Likewise. Thank you, Brian.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIG investor.com.